Alright guys, so in this video we're going to talk about liquidity, but also importantly external and internal liquidity. As I said, so many people ask me about this, but I wanted to simplify this in terms of how to define external versus internal, and then get into 4 examples of how I actually apply these in the markets. Now everyone knows that liquidity rests at old swing highs and old swing lows. It's pretty obvious. Most people understand that. However, there's a lot of confusion when it comes to what is external versus what is internal. Now for me personally, I use the 15-minute time frame to generate a narrative, and I use the 1-minute time frame to enter. Therefore, for me, any swing high or swing low that can be visible on the 15-minute time frame, I would class that as an external swing high or swing low. Anything on a small time, for example, the 1-minute, 2-minute, 3-minute, and so on and so forth, I would class that as internal. Now, we've zoomed here on the 15-minute time frame. We can see that any swing high or swing low that's formed here on the 15-minute time frame, these reflect external liquidity points for me, because if I'm executing on the 1-minute time frame, the 1-minute swing highs and swing lows, they are internal, but the external for me is the 15-minute. So all these swing highs and swing lows that we start to print, these are all external points. And if I just play that through, you can see we're forming many swing highs, many swing lows. There's one here, there's one here. So we're forming all these swing highs and swing lows. But then the question is, well, how do you use these swing highs and swing lows, and how do you know which ones are going to be important for liquidity sweeps? What I personally like to do, I like to pair not only the swing high and swing low in terms of external, but I like to pair external liquidity in terms of these highs and lows with external FVGs or fair value gaps. Most of the time, guys, you can use what's on the 15-minute time frame to give you a narrative, and you can also use 15-minute fair value gaps to determine when price is going to move in direction that you want it to move in. So how do you catch this up move? How do you determine that price is going to move up? You simply look for the 15-minute FVGs that sit around the current price action. So when you're looking at price action, there's important elements to keep in mind, and I'm going to mark out a few things here just so we can talk through it. Number one, we can mark out all the external points of liquidity. So we've got this low, this high, this low, this high, and I could do this and go on forever, right? Now what's important is to look for things around key time frames that you want to execute a trade in. For me, I personally like to trade the London Open session and macros. So between 2 a.m. and 5 a.m, I want to section off that time, and I want to see if there's any sweeps of external liquidity during that time frame. So what I want you guys to note is I'll mark it out with 2 lines here. 2 o'clock on my chart, I'm going to mark it with a line, and I'll make that a little bit thicker. That's 2 o'clock, and then 5 o'clock is somewhere over here. Right, so we're looking for anything important to happen in that time frame. Now, what you can see is that during that time frame, we have a sweep of external liquidity. Right, so notice how when price comes down here, we sweep external sell side and we sweep external sell side. Not only that, but we also tap into an external or high time frame FVG, and I'll mark that out just here for you guys. So we've got this fair value gap here on the 15-minute time frame. So again, all these swing highs and swing lows that we marked out, they are external points of liquidity. Then we're looking to pair that with external or high time frame fair value gaps and imbalances. So what we can see here, we sweep this external sell side. What's important about this sell side, guys, is that it actually represents the Asian sell side. So when you trade in the London session, you want to see sweeps of Asian liquidity. That's really important liquidity. This swing low, right? This swing low is formed at 7:30 New York time. That is just after the start of Asian session. Asian session for me, our class is 7 o'clock, 7 p.m. to 12 p.m. So we sweep sell side, Asian sell side. We then tap into this 15-minute fair value gap. Automatically, if I just go back, guys, we're now looking for price to react from this area. So what I can do here, we can zoom forward a little bit, right? Play one more candle out. And then we can go back onto a 1-minute time frame to see if we have any entries during this element of price or during this segment of price. Now look what price does here. Look, we sweep that element, we sweep that swing low, we tap into that fair value gap, which is really, really nice. And then we react automatically back to the upside. And this is where you pair the external and also the internal. So we've talked about external, we swept external liquidity. We've done that during a key time frame, and we've swept and reacted from an external fair value gap. That's external, but what about internal? So once we sweep external, we're probably going to take out something internally. And for me, this is where I talk about ranges or dealing ranges. So there's many, many ranges, but the first range I want to point out, just so you can see, is from this swing high to this swing low. Notice how that's like the last, price range to sweep this sell side. It's pretty obvious, right? We've got a swing high, swing high, swing high, but we're stepping down, and all these segments in price, they relate to the same segment of price action that moves to sweep that external liquidity. So there's a range. When you find your range, then you can mark out any swing highs inside of that range like this. Now these swing highs are internal. right? So we talked about external, now we're talking about internal. These are all internal swing highs. So ultimately, if you're writing notes down, when you sweep external liquidity and you tap into an external or higher time frame fair value gap, you're then looking to enter on an internal basis and target internal liquidity and internal fair value gaps. So this is internal buy side. Where else do we have here? We've got all these fair value gaps. Like there's one here, one here, one here, heaps of fair value gaps. Let's just mark out this top one here, just for the sake of this video. And then we've got these buy side points here. So ultimately, you're then looking for an entry model. And I'll just change this to red. That represents a sell side imbalance. I'll mark that out. I like to call these CVs, people call these CVs sell side imbalance, buy side inefficiency. It's just a bearish fair value gap, that's all it is. So ultimately, now you need to actually find some entry. So as soon as you sweep that low, you're looking for an entry. As soon as that low gets swept and we tap into this FVG, I'm now waiting for price to give me an entry. Now, you could enter straight away off this inversion. For me personally, I waited for a little bit more confirmation and I looked at this fair value gap here. So once it's got inverted, longs are a great play. So if we just play this out, you can see, haven't inverted it yet, but we're waiting for that inversion fair value gap to be created. Okay, beautiful. Now notice here, when does this inversion fair value gap get created? And this is when we're going to talk about all the other elements that are important. I'm going to mark out a macro here from 250 to 310. It's not random, guys, that during the macro, we have something important happen. Notice how, volume-based this candle is. It's really, really volume-based, and it's created a nice inversion fair value gap. You've got the pre-backing or the pre-analysis to say, okay, the market's probably going to go higher, and now you're going to use this inversion to enter long. Long position from here, stop below these bodies, and where can you target? You can target any of these zones. Again, internal liquidity now. Any of these internal points or internal fair value gaps are where you target. And we start with that. Now for me, that's enough. Like I don't need to take more than 10, 15 handles for London session. I'm happy to take 10, 15 and then call it a day. If you like to hold runners, that's when we can look for external points. So as price begins to play out, we hit that TP, that's done. That's 17 handles, sufficient. But for those that like to hold runners, you might be curious then, okay, well, what if price sweeps this swing higher? Because again, we marked out that range. Remember that range. We marked out from this swing high to this swing low, and that was the internal range. But what if we actually sweep that internal range? What then? What do we do? If we sweep that internal range, I look at the bigger range, right? So I'm just going to speed up the price action here. Let's go through it. Once we sweep that internal range, I look at the bigger range. What is the bigger range, or where are the other external points now? This is all internal. Where are the external points? Let's go back to the 15-minute time frame, right? That internal range that we talked about, guys, that we marked out, that internal range was from this swing high to this swing low, right? So we've breached past that. The question then is, okay, what externally could price be reaching for? And that is where we mark out again, any swing high, any swing low that we see on the 15-minute time frame like this, or even any fair value gap. So we can mark out this bearish fair value gap, we can mark out the one above that, and ultimately we can look to see if price is going to react from any of these points, right? So we just mark those out. Now we expect price to go to these levels. So notice in this example, guys, we've swept this swing low in the 15-minute time frame. We've reacted from this 15-minute or external fair value gap, and now we've broken past this internal range. Now we're looking for any fair value gaps from this swing high to this swing low. So again, the new range for me is now this. And what I do, the same thing that I did on the smaller range, from this swing high to this swing low, I mark it out. You can mark out with a box, and then look for any fair value gaps, look for any swing highs in that range, because those will be your targets. And that is where you apply the concept of premium and discount. You try to target things above the 0.5 level. However, price likes to react from fair value gaps and from liquidity, and we'll see a bit later on. So we expect this swing high to be swept. Let's see what happens now. If we play this out, what happens? Do we sweep it? Not yet. What have we created there too? What's here, guys? Relative equal highs. So we expect those to be really breached through with some displacement. There we go. Now, super quick. Look at how we push in that 15-minute candle. Now your question here is, okay, can we look for another trade now that we're in another 15-minute fair value gap? The answer is yes. Now what you need to do, guys, is you delete this, draw this across. Again, we've swept external. We're in an external fair value gap, similar to what we had down here. We've swept external, we're in an external fair value gap. Now what can I do? I can zoom back into a 1-minute time frame. Beautiful. So this is that 15-minute fair value gap. Now I'm looking for entry models. Let's see if price shows us that it wants to reverse. Let's have a look. Let's have a look. Now, you might say, well, yeah, you got a market structure shift here. But look at these two highs here. That is trendline liquidity. That's low resistance liquidity. It's not ideal. You would have rather this high be swept. So in this situation, if the price action did something like this, swept that swing high and then reacted, it's a bit more valid. In this case, because we have that massive push up on the 15 minute, it's probably not as favorable, right? Now this is all internal, right? We're playing the bigger external range, but this is all internal. Let's see if we get any more reversal signatures, or let's see if price is just gonna spool. That's it. So just because we sweep an external point doesn't mean you have to take a trade. You look and you observe price action, you see if you get your entry model. If you get that, you execute. If you don't, you don't. It's as simple as that. Right, and then if we go back to the 15-minute time frame, we can see here, we're now playing the bigger range. I assume that this high is going to get swept. Right, so let's play this out. I assume that's going to get swept. Let's see what happens. Bang. When this swing high is swept, where do I think price is going to go next? Right, let's go back here. Let's go one bar less. When this swing high is swept, where should price go to? Well, price should probably go to this swing high and potentially to the all-time highs. What I've got to do then, again, we've swept external liquidity. I zoom back into the 1 minute time frame. We've just swept this external high. Go back to the 1 minute time frame. That's the sweep there. Do we offer any reversal signatures after sweeping that high? No. So what's your anticipation? That that swing high becomes the drawn liquidity, and now we're moving externally even more. Let's see what happens. We take it out. We sweep this external swing high. Do we have a reaction? No. So what you're looking for is all these external points. You're looking for reactions after sweeping those external points, and then you're using the smaller time frame or the internal structure to execute and take your profits. Now on this next illustration, guys, I'm on the 15-minute time frame again, and we could do exactly the same thing. We can mark out all the swing highs and swing lows. These for me are going to be external points, and I'm watching to see what price does if we sweep one of these. That's really important. Now notice here, we actually sweep this level of sell side. So we sweep an external sell side point. What I'm looking for then, I zoom out on the chart, I zoom out like this, and I'm looking to see if there's any 15-minute fair value gap that we're also delivering from. And notice how in this situation there is. So we deliver from this 15-minute bullish gap. Now you might say to me, well, Ruben, how do you know that the price isn't going to go down into one of these other fair value gaps? Now, I don't know that for certain. However, what I'm looking at is the fact that we have external liquidity inside of this fair value gap. Notice how there's no other swing lows down here. The external liquidity is in this FVG. Therefore, if we're going to have a reaction, it should happen from this 15-minute gap. It shouldn't need to come back down here. If we had a swing low that was formed down here, then potentially, I'd assume we might come down. But because we don't, I expect this to be a reactionary point, right? So again, same thing. We sweep that external sell side. We sweep that external sell side. We then go back down onto a 1 minute time frame, and we're marking out our internal range. What's the internal range, Ruben? The internal range, I'll mark it out here. The internal range initially is from this swing high to this swing low. So this here is the internal range. That is where you're going to do most of the profit taking. And again, what you're looking for is you're looking for price after sweeping that external liquidity, after reacting from an external fair value gap, to show some kind of unwillingness to continue lower. So if we play this out then, look at this reaction up here. Look at this reaction up here. And you might say, well, okay, Ruben, we've now targeted all these internal points. What's next? If you just zoom out a little bit, the next range that we can use, and I'll mark it out, originally it was from that swing low to this swing high. Now we're going to move this up to there, and then to there, and then to there. But notice how this range here, if I just zoom out, that is all a part of the same structure. So if we then drew a brush here, we can see this. Right, that's a part of the same structure, the downwards trend that led to that sell side being swept. And to confirm that, we can go to the 15-minute time frame. And again, look at this. Notice how that box that I've drawn out goes from swing high to swing low from the 15-minute time frame. So we start with a smaller range. The smaller range is here. I'll mark this out. This is the smaller range. And I'll do that in, say, a blue color. The bigger range is in yellow. What's after that range? The other range is up here, guys. Like this is the next range. And then that's the next range. So you're pulling your Fibonacci, or you're pulling your box, whatever you draw it out from, you're pulling that from each swing high. You start with a 1 minute time frame. You look at what's there in the 1 minute time frame. If that range gets broken, you then go out in the 15-minute time frame and you mark out the next range and the next range. And then what you're looking for, because again, from this high to this low, that's the range we drew out, the second one, right? You're looking for swing highs and swing lows and fair value gaps in that range. And notice how in this range, it's all low resistance. And what do we know about low resistance? Low resistance should be targeted quick. Now this happened at the end of the day, but look at how the market opens again come the new day. Look at the new day opening gap. Look how large it is. Look at this, right? Really quick, bang. We create that massive new day opening gap over 100 handles. Why is it so drastic? All of that's low resistance. So see how we move from external, then we drop down, we look at internal. If that first internal range is broken, we expect the next range to be targeted, the next range, the next range, and these are all targets, right? If you're looking for high probability trades, you're using external liquidity on the 15-minute time frame paired with a fair value gap externally. Those are the highest probability trade ideas, right? And even looking at price action today, we can see what's happened as well, guys. We deliver from this, we push back up. Now what I'm going to do, I'm going to mark out all these swing highs here, right? I'll mark out this swing high. I'll mark this out. So I'll mark out this. I'll also mark out this. These are all the swing highs in the range. Let's see what price does. So we've now swept external. Let's see what it does. We go a little bit higher here, and we don't necessarily sweep this high. And you might say, well, wait a sec. If we sweep this external point, aren't we meant to get to this swing high? Yes. However, we've probably left that for a little bit later on. And let me show you exactly what's happening here on a smaller time frame. If we now zoom into price action right here, right? Have a look at price action here. And you'll see this, it's really, really clear. Look at this. Look at how we've got these three drives. 1, 2, 3. Let's have a look. Notice how close we come to that swing high. This is one of the reasons why you don't have to sweep liquidity, guys. A 3 drives pattern or SMT. In this case, we've got a 3 drives, and then we have a nice reaction to the downside. Look at the reaction here. Look what price does. It tricks people to think we're going to sweep that high. A lot of people are trying to target that swing high, but ultimately, where do we move back down into? We move back down again into these internal liquidity points, but also into this massive new day opening gap. So these are the things to consider when you're looking at external versus internal, right? External versus internal. Even if we go onto the 15-minute chart again, we can see this plays out time and time and time and time again, right? Look at this, right? Come back to the 15-minute time frame. Yesterday's New York AIM session, if I just drag this across, look at this. 15-minute swing low, 15-minute high, 15-minute high, 15-minute low. We sweep this sell side. Beautiful. So we sweep external liquidity. We could go back now onto a 1-minute chart as soon as we sweep that. If we just go back. And as soon as we sweep that swing low, let's go back to the 1-minute time frame. Are we around a macro time frame? Yes. Are we in silver bullet? Yes. So we go back here. And now we're looking for any entry models that say to us that we could be going long. We've got all this accumulation, low resistance. Let's see if we get any form of like inversion fair value gap. There you go. So there's your entry. So we've gone from external sell side sweep now to internal entry. And so say something like this, stop below the low. Now you might say, well, wait a sec, Ruben, these swing highs are way too close for me to target. So you might want to target at least that, or at least a 1-to-1. Now this smaller range from this swing low to this swing high, it's not feasible because the risk to reward is just too negative. So you're probably targeting something up here, at least a 1-to-1. And what range are you playing now? Well, the range you're playing now is from this swing high to this swing low. Or you could zoom out further and grab the bigger range. And let's see what price does. Let's see if price gives us a nice clean 1-to-1 trade. There you go. Right, so again, you're using external and then bringing it back into internal liquidity. And then once that internal range gets swept, you look at the next biggest range, and that'll allow you to pick targets. It'll also allow you to, determine when a high probability reversal will happen, which happens after external liquidity is swept and external fair value gaps are engaged. Hopefully this video has really shown you, how external and internal liquidity works, how to phrase trades using external and internal. But let's do one more example. And this is once we swept, or the other day when we swept the NFP Newsweek. Again, this is a 15-minute chart, and look what we do. We sweep that external liquidity. Again, we go back into the 1-minute time frame. All right, let's scroll down. That's that external liquidity sweep. So we sweep external liquidity, then we're looking for an internal entry model. In this case, there's an inversion fair value gap. We're looking at the internal range from this swing high to this swing low, and we're targeting anything inside of that range. We've got a swing high here, we've got a fair value gap there. That in itself can be a trade. That is completely fine. But a lot of people don't like that idea. They want to go for something else, and that's all right too. So we sweep external, which is an important wick, being a news wick. We look at the first range of the target. We look for an internal entry model. That's completely fine. What else do we have? We've got this. Now you might say, what is this? Well, this is how you use both external and internal, but pair both things together. So we've got that initial range here, which we could have targeted right there. However, you might be waiting for a better trade. You might be waiting for something else that fits your model. You might be looking for something else. This could be that something else. So we start with the external, we move internally. And then notice here we sweep internal liquidity and we've got an internal entry model. So a lot of people say to me, well, what about a trend continuation? What about when price has already delivered a little bit, but you're trying to catch the second portion of that move? This is exactly how you do it, or this is how I do it personally. So notice here, guys, we've got that original external sweep that happens during a macro. We've got the next internal sweep that also happens during a macro. So this is the AM session. This here is the PM session just after the lunch hour. Perfect. We've got accumulation, manipulation, distribution. We're using that pre-existing knowledge to then take a trade here, using an inversion fair value gap. So you don't always have to enter just after an external sweep. If you miss that initial trade, you can use it as a backing, and you can expect or anticipate, because we've swept external, if we're going to move higher, this swing low should hold, right? The external sweep should hold. So as soon as we sweep that internal liquidity, you want to see a reaction from that. And ideally, if it happens during a macro, better, high probability. You look for that inversion, you can take that long, and you can target the initial range that we talked about before. So hopefully this video illustrates the importance of external versus internal, an in-depth masterclass or guide into how you can actually use it. If you enjoy this video, guys, let me know below. If you're not subscribed, subscribe to the channel, and I'll talk to you guys next time. Peace.